America just did something it had not done in nearly 28 years. It stepped in to help buy yen, but Wall Street should be watching this more closely than Tokyo, because the real risk is not the yen. It is what sits behind the yen. Trillions of dollars in global leverage. U.S. treasuries and expensive tech stocks have all benefited from cheap Japanese funding. So if Japan finally changes the price of that cheap money, the shock does not stay in Tokyo. It comes straight into American markets. Do not treat this as a currency story. Break the machine apart. At the top, you have cheap yen. Japan's policy rate is still only 1%. That cheap funding feeds the next layer. Banks, hedge funds, and leveraged investors. They borrow yen, convert it into dollars, then buy higher yielding assets, treasuries, U.S. stock, and global credit. Where does the profit sit in the interest rate gap? Cheap yen funding, higher U.S. returns, and for years a weaker yen helped too. That is the machine. Now find the bottleneck. It is not how many yen Washington buys this week. The bottleneck is the cost of yen funding. On our cross-asset desk, we break this into funding leverage and the final asset. Japan still holds about $1.14 trillion of U.S. treasuries. So this relationship is not small. If the yen rises quickly, carry trade economics change. Leveraged funds may need to sell dollar assets, buy yen, and repay their funding. That can transmit straight into treasuries and U.S. equities. I map full chain from yen funding to treasuries and NASDAQ. Message me yen for the full map. Now here's the important distinction. FX intervention changes the speed of the currency. OJ policy changes the economics of the trade. The Bank of Japan is already at 1%, and further hikes remain possible. If funding moves from 1% to even higher levels, the interest rate spread shrinks, and money will not stay equally profitable at every link. The real risk is not yen at 160 or yen at 157. It is what happens when cheap Japanese funding stops being cheap. So the next link I would track is the Bank of Japan. If the BOJ keeps tightening, who absorbs the loss? Yen-funded investors, U.S. Treasury holders, or expensive U.S. tech?